It's 2025, and you're ready to buy your first place, so it's time to find your dream home and then live in their tent. When buying a property, the very first thing you need to do is plan your finances. Start by preparing savings for the purchase. You could improve your monthly budget, take on additional shifts at work, or finally respond to that Nigerian prince that keeps emailing you. You'll need the down payment first. This is typically about 20% of the price of the home, but could go as low as zero in the right situation, like for veterans, or if your parents have a bit too much money. Closing costs should also be ready before starting. They will likely land in the range of 3 to 6% of the total price of the home. Regardless of your savings, you'll likely need at least 2 years of stable and reliable employment, like an accountant or YouTuber. When it comes to the amount you can afford, you should be paying no more than 30% of your monthly incomes towards your total housing bill. There are lots of calculators online which will show you all the fees involved with home ownership and exactly how much you can expect to receive from a mortgage lender. This is also the time to check in with your credit score. A score above 620 will give you a realistic chance at securing a loan, and anything above 740 will grant you access to the best rates available. For anyone who needs help with their score, it's actually really easy. Just have more money. Once you've planned your finances and figured out your budget, it's time to find an agent. Certain people might say you don't need an agent, but any money you save on them will likely be far less than the amount they will save for you. Keep in mind, your old college roommate will offer to be your agent, despite never being one. Instead, find a realtor who is familiar with the area and is willing to guide you through the whole process. Try and knock on other homeowners' doors and see who they recommend. It's statistically unlikely that they'll all own Make sure to get pre-approved before getting started. The last thing you want is to find your dream sidewalk just to find out you can't afford it. There are a couple different loan types to consider when applying. The most common loan type is the conventional loan. It's a private loan for individuals typically with stronger finances. Often best for those able to put 20% or more down to maximize what the conventional loan offers. This is the mortgage your grandparents likely had, before the American dream died. Next, the FHA loan is a loan backed by the government and is best for individuals with lower credit scores and less financing for a large down payment. You could put as little as 3.5% down on an FHA loan. However, you will need to pay an additional monthly mortgage insurance premium as a trade-off for these perks. This premium will remain present until the loan is completely paid off. While this might not sound ideal, you will be able to refinance the FHA loan into a different loan type that doesn't include the premium once your situation allows for it. For example, you might want to refinance into a conventional loan once you have 20% or more equity in the home. At this point, the monthly mortgage insurance premium will be eliminated completely. VA loans are great for veterans, service members, and their spouses. They are government loans which provide benefits such as lower interest rates, no down payments, and zero monthly mortgage insurance. Because what better way to say thank you for your service than saying, we're not gonna help you get a place to stay, but at least we won't charge you extra if you do. While there are many other options out there, these are the main three. Regardless of the type of loan, on your application, lenders will want to see these documents. In order to get your full credit report, lenders will need to do a hard pull of your credit. This scares a lot of people because a hard pull will negatively affect your credit score. However, it will normally drop at most 5 points and have little effect on your overall credit health. If anyone's wondering why your credit score would drop at all for simply looking at it, don't. This will also give you a 45-day window after the first credit inquiry is made to apply for as many loans as you would like without any additional effect to your score. Use this time wisely to shop around for as many loans as you can get. You're not limited to the bank, credit union, or couch cushion that stores your money. Apply with different banks, unions, online lenders, mortgage brokers, and that one creepy uncle to find the best rate. Just like any other purchase, you don't take the first price you see. No, you wait until Black Friday, then fight over clothes with a single mother who's just trying their best. After picking the best offer, you'll receive the pre-approval letter with the loan details and how much they're willing to provide you. Now it's time to start hunting. Start by making a list of the things you want in a home, then have a few glasses of wine and cry over what you can actually afford. There are a lot of things to consider when looking for the right place. Make sure to take the time to figure out exactly what is important to you before making any decisions. Be sure to use your realtor's knowledge and resources to find places that suit your needs. Try to see the homes in person if the option is available to you. Then spend the rest of the day scrolling through the thousands of homes on Zillow that only about 10 people in the entire world could possibly afford. Once you find the place with the least number of cockroaches, it's time to put in an offer. While a good agent will take care of the details for you, it's important to know a few key things. Your offer should include your personal details as well as how much you are willing to pay for the home. Your agent should have a good understanding of fair market value, but it wouldn't hurt to compare the price with similar homes recently sold in the area. Most offers will include an earnest money deposit, or an EMD, which is about 1 to 3% of the sale price. price. EMD is used to show sellers that you are a serious buyer, compared to everyone else who just write contracts for fun. If the seller agrees to your offer, the EMD will go towards down payment or closing costs. However, if you back out after both parties have accepted the deal, you may lose that deposit. This is why it's important to include certain contingencies in your offer, in case anything goes wrong in the process, in order to protect things like your EMD deposit. Finally, your offer letter should include a deadline for the seller's decision. You might need to negotiate your original offer, but once it's accepted, it's time for the due diligence period. While it might feel like the house is already yours at this point, there are still a few vital things that must be completed before it's official. Right away, you should get the house inspected to ensure you're getting exactly what you're paying for. There are lots of inspections you have the right to do on the property in addition to the general inspection before closing on the deal, and you should do them all. Keep in mind, you will be liable for any repairs after the sale closes. The general inspection might come back with 0 issues, but the roofing inspection would see the massive hole in the ceiling, and the plumbing inspection might notice that the toilet and bathtub were repaired with ramen noodles. Make a list of all the issues the inspection might find, as you have the right to renegotiate the deal before it's finalized. In addition to the inspection, a home appraisal must be done. While it might be cool to see exactly how much the house is worth, the appraisal is done more for the lender than it is for you. This is because lenders cannot lend more than the appraised value of the home. For example, even if you are approved for a $500,000 loan, if the appraisal comes back at $450,000, your lender won't be able to give you the additional 50 grand. In this case, you'll be forced to either cover the 50 grand from your own pocket or renegotiate the sale price with the seller. This is the point when you should ask for repairs or credits based on the inspection and renegotiate the price based on the appraisal. Assuming your offer letter was drafted well, it should include both inspection and appraisal congruencies. These congruencies would allow you to back out of the deal without losing any deposits made if problems arose in either of these areas. This way you have control over the negotiations, rather than being at the mercy of whatever the seller feels like. These negotiations could include a few things. You could ask for a discount on the original price, request credit towards the closing cost of the home, ask the seller to fix any problems before the deal is completed, or just move in. What are they going to do? Sell it to someone else? You already live there. Eventually they'll cave and just give it to you for free. Be prepared to walk away if you are not happy with the outcome of the negotiation, or you can't handle the sinkhole that just formed in the living room. I know it can be hard when you are so close, but think about all the other homes that are already in the sea. Finally, it's time for the home stretch. All that's left to do is to give a ton of money to a stranger for an asset that could be destroyed by a tornado at any moment. After closing the deal with the seller, your lender will provide you with the closing disclosure. Take the time to read it over and make sure all the information aligns with your original loan estimate. Make sure to bring your ID to the closing meeting, along with the money for a down payment and closing costs in a large duffel bag with a cartoon money sign on it. Come to think of it, a cashier's check might work better. After payment, you can sign the mortgage note and it's official. You're a homeowner. Now you just need to hope the housing market doesn't crash. Now, obviously this video was satire. None of us are ever going to be able to own a home.